Hello and welcome back to myhappyassets.com. I wanted to talk real quick about some alternative ways to reach financial independence, which are mentioned in the book My Happy Assets, which is available on the website myhappyassets.com. And again, financial independence is the point at which your passive income is equal to or greater than your expenses, and then you can choose to work or not. You're financially independent. But it doesn't always have to be through rental property. You have options in stocks as well, and even though the stock market is going up and down, you can still find great sound fundamental stocks that deliver a good yield. Yield equals to cash flow. So the three that I want to talk about real quick are ETFs, REITs, and royalty trusts. So an ETF is a basket of stocks. It trades like an index mutual fund. It's actually tied to an index, and it actually trades throughout the day like a stock. But in some ways, it's like you're getting a mutual fund. The fees are low, but you do pay a commission on those because since it is similar to a single stock, or it trades like a single stock. So that's one of the cons to it, but it can deliver on a high yield. It's more tax efficient as well because there's less churning within it. It's just indexed to, say, the Dow Jones. A REIT is a real estate investment trust, and that is it's a basket of companies that actually own physical property and manage them as well. So you are getting some diversification into real estate, but don't take it as if you own a REIT that you own real estate, because it's not the same thing. You still own a stock, which is correlated to the stock market. They do pass through the depreciation that real estate will get and pass it on as yield from their tax savings, but you lose out on some of the natural advantages that real estate has, like leverage and the pure tax advantages, depreciation, and other things, and plus you've got that stock market correlation, but it can deliver a good yield. The last thing is royalty trusts, which are like a financial wrapper for holding a group of assets and their operating companies. These operating companies own hard assets such as oil reserves, timber, natural gas, and mineral companies. And a lot of times they're involved in energy exploration. So again, they own a group of companies within this security. So it's still a stock. Pays out a high yield though. So one of the things to watch out for on royalty trusts is that sometimes their yield is so high they have to make a return on capital to you instead of paying out of earnings. So once that happens, they're actually returning your investment to you, and you don't necessarily want that. You want to make the investment, it pays a yield, and it lives on forever and ever and can deliver on that yield. So, and of course, if anybody ever cuts their yield or just omits it completely, you should be tuned into that, and you, in theory, should be able to move over to another security or another investment. So again, yield is equal to cash flow, and enough cash flow that meets or beats your expenses, you're financially independent. And I covered the ETFs, REITs, and royalty trusts. I go over the details if you're interested in those in My Happy Assets, which is on myhappyassets.com. So again, remember, it doesn't always have to be just rental property. Rental property is a great way to invest as well. It can deliver cash flow, but there are other ways to generate passive income, passive cash flow, and not just being rental property, which comes with its own challenges as well. So again, check out myhappyassets.com and check out the book My Happy Assets. Thanks a lot. Have a great day.